We maintain our positive view on the travel sector. We do have an ad rating on each stock. Clearly, each stock has slightly different, I suppose, drivers of the theme, so stick with your favourite there. But we do expect solid earnings growth from the sector over the next couple of years as they continue to recover from COVID, and you can see FY25 valuations remain attractive. What are we seeing in terms of the state of the market? Well, first of all, as you can see, leisure travel continues to materially outperform corporate. And just coming through the quarterly airline reporting season in the US and Europe, they're saying that leisure demand remains strong. But turning to what they're saying on corporate travel, they're saying they're seeing an improvement in corporate travel demand. In fact, United Airlines called out a week ago that in terms of January, which is the start of the new budget season for the big corporates, they've seen a big step up in demand for corporate travel. And they said this is giving us some good confidence that 2024 should hopefully be a good year for corporate travel demand. They also said they're seeing a nice step up in the demand for London to Heathrow business travel demand. Clearly, in that fourth quarter of calendar 2023, the conflict in Israel did have some impact on demand, particularly for some of those countries in Europe. We understand that sort of slight downturn has now moderated. If we look at the domestic leisure travel market, it has slowed, but from the peaks after us all having 3 years of holidays at home. There's now, a big switch to international travel, and potentially adverse weather over December and January did have an impact on some domestic leisure travel in certain locations. In terms of Australian outbound travel, which is the other chart on the slide, you can see it continues to recover nicely. In December, it was at 91% of pre-COVID levels. International airline capacity continues to return to Australia, and airfares are falling. And in regards to the inbound travel, that is lagging outbound growth, and it's the Chinese market in particular that's been slower to come back. And then just lastly, in terms of the demand for cruises, it remains extremely strong, and the forward bookings for cruises out the next couple of years are very, very solid. Look, there aren't any of the travel agency businesses we've specifically called out as stocks to watch on either the negative or positive, except for Alliance Aviation, and Billy's going to talk about that shortly. And that's because, just remember, the travel companies have a material earnings skew to the second half. Also remember, in the first half, they generally report cash and quite large cash outflows. But also, note that the balance sheets are in very strong shape, and for the full year, cash flow conversion will be very solid in line with seasonal trends. So, Billy, I'll pass over to you on Alliance.
So within our travel coverage, Alliance Aviation is our only key result to watch heading into reporting season, which we think can positively surprise. Alliance is set to report a very strong result, albeit as comping a weak PCP. And we forecast underlying profit before tax to be up 186 on the first half 23. And this is driven by Alliance's ongoing fleet expansion. So we think Alliance can positively surprise by potentially upgrading its guidance, which we think is conservative. At its AGM, Alliance said it was comfortable with FY24 consensus underlying PBT of 83.7 million, and that the second half 24 will be significantly stronger than the first half 24. With the upcoming result, we are looking for Alliance to provide a more formal PBT guidance range as it did at the first half 23. So our first half 24 forecast currently assumes a 45-55 skew. However, we believe that Alliance could see a larger skew than this in FY24, as noted by its guidance for a significantly stronger second half. It is important to remember that Alliance achieved a 30-70 skew in FY23. So if Alliance were to achieve our first half 24 forecast of 37.8 million of profit before tax and applying a larger 40-60 skew, this would see us upgrade our FY24 PBT forecast by 12%. Alliance evaluation remains extremely attractive for a quality founder-led business growing at double-digit rates for the next few years, with it currently trading on 9 times FY24 PE and 4.9 times FY24 EV to EBITDA. We also highlight that the CEO, MD, and founder bought over $300,000 worth of shares at the end of December, which we think is a very positive sign for the company. Today, we also wanted to touch on some of the results of our more topical travel stocks, starting with Qantas. So with Qantas, we're expecting its first half 24 PBT to decline 12.7% on the PCP, but we expect EPS to only fall 3.2%, reflecting all of its share buybacks over the past 12 months. And we do note this is still Qantas's second strongest result, first half result on record. So whilst we lack strong conviction, given our concern Qantas might have to still further reinvest in the business to repair its brand and reputation, we do think it could beat consensus estimates at the first half 24. Now, why is this the case? Qantas was buying back shares up until the end of December, and it also has not provided any first half 24 guidance. So to us, this potentially means it was likely tracking close to consensus PBT at the time of $1.3 billion. Since the end of December, consensus PBT has actually declined 4.4% to $1.25 billion. So we think we could see a small beat on that basis. There also continues to be a lot of negativity in the share price, with the stock trading on only 5.9 times FY24 PE. And our channel checks suggest that over the December-January holiday period, its customer service offering has improved. The press reports also have recently reported that Qantas saw a doubling in its key measure of customer satisfaction from November to December. Oil prices and refining margins have also moderated materially since Qantas's last market update in September. And there has also been a slight appreciation in the Aussie dollar, which should help the second half 24 and potentially see some consensus upgrades on a lower fuel cost. Importantly, travel demand clearly remains strong, and over the holiday period, roughly 8.5 million people flew on Qantas and Jetstar services throughout December and January on nearly 70,000 flights. And this is more than 500,000 more people than last year, and it's the most since pre-COVID. So before handing on to Belinda, I'll also touch on SiteMinder's quarterly yesterday, where it delivered another solid update, all in line with consensus. For the first half 24, SiteMinder saw revenue growth of 27.9%. And a key positive for us was its organic revenue growth beginning to reaccelerate, albeit only slightly, after a period of cycling strong comps whilst emerging from COVID. Importantly, SiteMinder's free cash flow outflow continues to reduce, with a second quarter outflow of $3.1 million. That's down from $5.5 million in the first quarter. And remember, SiteMinder is set to be EBITDA and free cash flow positive in the second half 24. Finally, SiteMinder also said it's making good progress on the launch of its new product, Dynamic Revenue Plus, which remains on track to be released in the middle of this year. And as highlighted in our recent research, we think this product could be transformational for the company. So with a couple of broker downgrades overnight, downgrading the recommendation, from buy to hold overnight on valuation, we could see some share price weakness today, which we would view as a buying opportunity. I'll now hand back to Belinda to talk about CTD, Flight Centre, and Helloworld.
So starting with Flight Centre, what are we expecting? Well, we're expecting, a very, very strong result, but it's compared to sort of COVID lows in the PCP. But just remember that earnings for Flight Centre will be materially skewed to the second half, and even more so in the future than, say, pre-COVID, just following that acquisition of Scott Dunn, which is a very high margin, high growth luxury travel business. In terms of the full year, we think their guidance will be reiterated. And with the result, the market's really wanting them to firmly commit to this 2% margin target, or just get rid of it and focus on absolute growth. In terms of what we're thinking about that 2% margin, we think leisure can easily achieve that, and you'll see them sail through that with the August result, which is the FY24 result. What sort of, I suppose, a drag on that margin is the corporate travel business, particularly their exposure to or their FCM Travel Solutions business, which has a massive exposure to really big corporates, and that's just lower margin work, and then the losses coming from their other division. So I think, if the team can fully commit to it, and we understand they are, that will be well regarded. And just remember, if they achieve that 2% margin, there is material upside to consensus estimates and valuations in 25. If we turn to corporate travel management, we're also expecting a very strong result. The great thing about this result is we think the earnings skew to the first half will be greater than what we've seen in the last couple of financial years. In the last couple of financial years, we've sort of seen a 30% skew to the first half, 70% second half. What we're thinking for the first half 24 is they'll deliver about 38% of our full year forecast. So they clearly had a very strong first quarter, which blew most people away, how strong it was. Now, we think they're not going to be able to match that in the second quarter. They wouldn't have been immune to the war impacting corporate travel demand, particularly, the US going to Europe. And also, the second quarter is now their seasonally slowest, just given Christmas and Thanksgiving holiday period where the corporates aren't travelling. We think they'll also reiterate that they're on track for at least the midpoint of that FY24 guidance, and they'll reiterate that from FY25 onwards, they're targeting to grow at mid-teens EPS growth per annum. Now, in terms of the big catalysts for the stock in 2024, we think if they can get on the US federal government panel, which roles for some of their biggest departments are currently up for tender, an outcome should be known by about September. This would be a great catalyst for the stock, and we think it would also be the catalyst to transform the US earnings to more acceptable levels, as we've seen what's happened in the UK where they've won plenty of high margin government work. And then lastly, if we turn to Helloworld, its earnings, I suppose they have a greater skew to the first half, unlike their peers. We think they'll be nearly halfway there with their first half result. We're forecasting a first half skew of about 46%. The EBITDA margin should be the highlight of the result. It will be materially ahead of pre-COVID levels, just given the structural cost out, the benefits and efficiencies of their new systems, and also that higher margin ETG acquisition. In terms of guidance, we think they'll reiterate it. So we don't think we're going to see the massive upgrade cycle we saw last year, but reiterating it will be a very strong outcome, just given, the war would have had some impact. There is a softer domestic market, as we've talked about. There is a lag in inbound travel, and declining airfares may have some impact on their overrides. But we do think this stock is materially oversold on war and macro concerns. And if you look at the share price charts just over the last few reporting periods, you'll see that this stock really sort of dips heading into the results. And then when they deliver the solid results, and Andrew Burns has his 2 weeks of roadshows, you see the stock really rally hard. So this could be a good reporting season trade.